Imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. Forecasting what the Fed's going to do is the easiest thing I do. The Fed actually tells you. All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. And Jay Powell is probably sick. He's given 6 speeches, either post-FOMC meeting press conferences or like the Brookings Institution speech at the end of November, Jackson Hole, August 26th. He keeps saying the same thing. He says, inflation is job one, period. We're not really worried about anything other than inflation, and we're not going to rest until we get it down to 2%. And he said, we're going to have a recession. He didn't use the R word, but you don't need a decoder ring to figure that out. He said, unemployment is going to go up. The Jackson Hole speech, he used the word pain, like 5 times in one paragraph. I've been doing this for 45 years. I've never heard a Fed chairman use the word pain. He said, there's going to be a lot of pain. You're going to feel the pain. But the point is, he meant it. And they've been going down that path. So what are they trying to do? They're trying to get to something called the target rate. And you say, hey, Jim, what's the target rate? Well, I don't know what the number is, but neither does Jay Powell. Nobody knows what the number is. But the theory is that the target rate is the rate at which rates are high enough that inflation comes down on its own without further rate hikes. So what's that number? The Fed thinks it's 5 1/4. The market somehow thinks it's like 4 3/4, which we just got to, or maybe 5, but it's most likely 5 1/4, possibly higher, but I'll settle on 5 1/4. The Fed's not there yet. They're going to have to raise another 25 basis points in March 22nd. That's the next FOMC. And again in early May. Those 2 additional 25 basis point rate hikes, in addition to what we've just seen, will get you to 5 1/4. And then from there, you go to the pause, and they use the word pause, and Powell's like, that could last a year, maybe early mid-2024, we're looking at rate cuts, but we've got to get inflation under control. I mean, inflation has come down a lot. If you it started dropping like a stone in July. Now I'm not talking about CPI. The Fed uses, PCE, personal consumption expenditure, core, meaning throw out food and fuel. Most people are like, what? That's what I spend most of my money on. But anyway, that's how the Fed does it. I always say if you want to understand the Fed, you can't use your mode. You have to put yourself in their minds, or you're just going to get it wrong. So PCE core comes up monthly, but they do a year-over-year comparison. That's what they want to make 2%. But just using CPI, which is better known, has come from round numbers again: 9, 8.7, 8.2, 7.5, 7.1, and now it's down around 6. That's a lot, but you're still pretty far away from 2. So nice job so far. But you're not where you want to be. And the Fed said they're not going to rest until they get there. Now, here's the Fed's, I hate to use the word conundrum, but sometimes it applies. Here's the Fed's conundrum. They're raising rates and inflation's coming down. That's clear. But what they don't know is, are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it, and they keep tightening, which they are going to over tighten, probably already have, and this is going to be part of what throws the economy into a severe recession. So that's kind of what the Fed's doing and how they think about it. Now, let's go to our next Irish storyteller. This is the market, and in particular, although here we probably have to distinguish between the stock market and the bond market. The bond market's a lot smarter. But the stock market is saying, yeah, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5 1/4, before they raise rates in May, maybe even March, maybe they're done. And because of a recession, the Fed will get the wake-up call, pivot, the famous word pivot, meaning cut rates, and that will bring the economy in for a soft landing. This is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro dollar futures yield curve, German bunds yield curve. I mean, there's a million yield curves. I pick your maturity, but you can look at the spread between 3-month Treasury bill rates and the expected 3-month Treasury bill rate 18 months forward. I mean, it's a little esoteric, but you can call that up. They're all inverted. Now, inversions happen, just meaning the longer term rate is lower than the short term rate. Now, this is in the Treasury yield curve. They're inverted from 1 month to 20 years. It's not like, people talk 2s and 5s and 5s and 10s. And 1 month, a 1 month bill is yielding more than a 20-year note. Okay, that's inverted across the entire yield curve. Euro-dollar futures, same thing. The inversion kicks in. It doesn't kick in immediately because the Fed does control very short-term rates and they're raising them, but the kink kicks in like in March 2023, which isn't that far away. Even the inversions that have happened in the past, which are rare, have not been as steeply inverted as they are now. We're seeing something globally we've never seen before, and it is the best single indicator of a recession. Okay, now let's get our third storyteller. Maybe I got 4 in this thing. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed is probably over-tightened. They probably are at the so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but rate cut in August, maybe. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. This is exactly what happened in 2018. I mean, the stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? December 24th, 2018, when it dropped, I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. That's not enough to get the Fed to act, but a so-called disorderly crash will. But that may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. And so I agree with the market that we're going to get a pivot, but I completely disagree. In my fairy tale, Little Red Riding Hood gets eaten.